Hi, I'm Mark Roseno, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our Primary Vision Frac Spread Count. And today we're going to look at the Frac Spread Count. We want to look more at what is happening on the refined product side based on what's in the US, what's abroad, how are things going to start really moving. And then we're going to go deeper into how is China going to fit into that when you look at the amount of storage they have and can they really come into the market. And then we're just going to provide a brief update on some of the recent econ data for the US. But again, just a few slides because we'll do more on that next week. And we had a very in-depth econ show this past week. So we want to give you a little bit of a breather as you enjoy the Memorial Day weekend. So without further ado, we have the Primary Vision Frac Spread Count was down by 5. So we went from 288 to 283. There's typically this little bit of a lull into Memorial Day. So this isn't a huge shift. There was a drop in the Permian. There was a small drop in the Anadarko. But again, these are things that we expect to come back fairly quickly. Same with Louisiana. But then when you look at Western Gulf, which is really when you're starting to look at East Texas, that was starting to go up. So again, there's a lot of reasons why some of the additions are going to stay there. Some of the things that came down just because of holiday time, just things in transit or moving, will come back. And I think that's really going to put us right at that target that we had given of about 290 by the end of May. So again, we're definitely right in line with what the expectations are. The next question is, when do we get to that 300? And there's enough capacity out there to get to the 300. It's above that you really start to hit a wall. There's probably about 325 spreads out there. There's probably about 315 that are likely. But that's where you're capped at that point. There's not much to go above that, which is why we expect to see a little bit of this slowdown as we go up from 290 to 300 and then really kind of stick there until we get further into the summer months. Now, there was a small drop in rig counts, where the rig count came down by 1. Two oil came off, one gas came on. When you break it down to what came off and on the directional horizontal, there was actually 2 horizontals that were added, and there were 3 directionals that came off. So again, the horizontals keep coming back, and the drops were all in Louisiana. So we still had activity picking up in other areas. So again, there's just typical movements. We expect this to be the case where we had some really big rig moves over the last couple of weeks. So it makes sense to kind of have a little bit of a lull, especially in front of a holiday weekend. So and then obviously, what does Memorial Day kick off? But the driving season. So when we look at Google mobility, TomTom congestion, there's usually a little bit of a lull ahead of it, and then you get that nice little spike. It normally starts either Thursday or Friday of this week and then progresses through about Monday or Tuesday. I know that some schools now provide an even longer weekend, whereby providing Thursday and Friday as days off, which I kind of wish I had growing up, but that's neither here nor there. So when you start looking at the Google mobility data, we do expect to see that bounce back up, especially in the Americas. Things in Latin America have picked up a bit, especially in Mexico, which is where some of that U.S. gasoline has been going. And then in the Asia Pacific, we do expect that to roll over just a touch. And then the same in Europe, we expect it to just hold just at about 100. So the Americas continue to be a little bit of the laggard here, and the Asia Pacific, depending on which metric we're using. But when you average them all together, we're about 93% of normal. So again, still getting there. We should close that gap briefly just because of the shift that we have in driving with the Americas. And it's interesting when you look at what's happening in the U.S. when you start looking at the daily national average of gasoline sitting there, pulled back just a touch to just below 460, but also when you look at airlines. So when you look at airline tickets going back through the late 90s, you can see that again on an airline basis, on a driving basis, the costs have continued to go up. So when you look at they face gasoline prices creeping to new records, airline fares having surged about 33% year on year. So again, these are the things that we have been talking about as the hindrance going into the summer months. And by the hindrance, we mean in terms of the seasonal bump. Typically you get a seasonal step up in the summer months in terms of travel, vacation. We just think that there's going to be a little bit less of that bump. And demand destruction in the U.S. comes in the way of just not getting to where you should be, but maintaining a little bit of that slowdown in general. But regardless, the gasoline prices are very conducive to bringing product into the U.S. because most of the gasoline shortfall is on the East Coast or PADD 1. Now, if you remember on the EIA show in segment 3, we talked about how the gasoline inventory in Europe had dropped significantly. And that was just because there's a huge armada coming into the U.S. We talk about that in segment 1 as well. But you can see now that there was a big build in gasoline in Europe. That the only time gasoline storage was higher this time of year in Europe was in 2020. So again, there's still more than enough gasoline to keep Europe filled, as well as export that excess coming into the U.S. On the gas oil side, that is not the case. They still remain at a very low level. They've been importing more and more from Asia with another slug coming from the Middle East. We don't see that changing. We do see more Middle Eastern product coming over. And we talked about that in segment 3, where Kuwait and Saudi Arabia bringing on some additional assets, and they're mostly distillate assets, so that will, again, provide some relief, as small as it may be, into the European markets and the Atlantic Basin in general, because not only is PADD 1 or the East Coast in the U.S. short gasoline, we are very short diesel and distillate. So again, there's the Atlantic Basin is going to be a very attractive market, especially as we get more Chinese exports, and that Chinese exports will help push some of that product coming further into the Atlantic area. So then we look at light distillate in Singapore. You can see that there was a big increase in storage, though, like we were predicting, where we expected to see a big bump in light distillate and residual fuel. But as we said in the EIA show, we did not expect a big increase in the middle distillate side. And again, middle distillate is at a record low going back to 2007. So again, there's still a big diesel shortfall. A lot of reasons why that crack spread will remain strong. But again, light distillate, gasoline, built again, sizable build. Same with residual. So again, it's the bifurcation in the markets where there's enough gasoline in the global market, but diesel's the problem. But when you make diesel, you inherently make gasoline, and that's where that conundrum. So again, you're trying to use the crude grades that have the best opportunity to create the highest distillate cut and the smallest gasoline cut. And that's where you're going to continue to see some of that pitfalls and those shifts in terms of what types of crudes are run. Now, when we look at the fuel surplus, you can see that China's net oil exports have been growing. There's an expectation that the new quota will be 3.5 million tons, and that's just because of the lockdowns, because of the quick ramp up. With some of the lockdowns remaining, uncertainty in Beijing, there's still not a lot of or normal activity in China. And the international markets are frothy. So might as well take the excess and go hit that market and try to capture, especially given that they have been able to buy cheaper crude from both Russia, Iran, Venezuela. So again, that just helps their spread even more and would incentivize some of those exports. So we do expect to see more of that coming into the market. And then when we look at Russia, as we've been saying, Russia that has more crude on the water than ever before, and that's just not going to stop. You can see it's been really progressive since they invaded Ukraine, and then as we've gotten into May, it's been holding above that 70 million barrel a day line, and we expect it to be between 73 and 75 million barrels. And again, it's just the amount of crude that's going to continue to come out because it's the only way to do it, given that they can't send it by pipe into Europe. So again, they're going to have to turn and send it into the international markets, which is why and especially mostly Asia, and which is why you're getting those steeper discounts. Now, when we look at some of the activity in the U.S., when we look at some of the flows, trade balance increased a bit. It's still negative, but as it always will be, just given that we're an importing nation. But you're still seeing a fairly sizable negative. But again, it was still a benefit in terms of the bump. Retail inventories dropped a bit. It rose, but again, a little bit slower than what estimates were. That's a net positive in terms of some of the additional movements that we will be seeing coming through. Wholesale inventories fairly stable. Personal income missed estimates by just 10 basis points, but still in a good position. Personal spending, and more importantly, real personal spending, remain fairly strong. So again, this is something that normally happens when you think about the beginning of April and the beginning of spring, as people do spring cleaning, you buy new clothes, new stuff. So again, this is a positive, kind of normal kickoff. But we really want to see what May looks like, because May typically sees a little bit of a slowdown, but how much? Is this something where we had some weakness, then we had a nice little spike, and then it comes back down? So I think those are going to be some of the key pieces that we want to look at as the PCE deflator and core deflator continue to show growth, obviously at a smaller pace. But remember, April had a lot of things cool off a bit. On the flexible side, that is looking at gasoline, at diesel, at some other flexible components, and that is all reversed in May. So again, the one thing that we've been saying is that May is going to be worse than April on the PCE deflator, core deflator side. So that's going to be something to watch, because some individuals are saying that, we're at peak inflation, but again, we don't think we're at peak inflation yet. We hold to the fact that we think inflation really peaks closer to June, and by peak we just mean that it really stops going up and just goes sideways, because June we think is going to be that last push before I've given barring anything from crude and otherwise, but that's where we think we get there and then hold that level. University of Michigan sentiment continued to worsen. Worst, I think, is going back to 2007 now. 2008. So again, we're continuing to see some deterioration in terms of how people are looking at the market. Expectations for 59.1 came in at 58.4. Expectations were future expectations were expected at 56.3, came in at 55.2. So again, people are being a bit concerned. So now just breaking down a bit on the the PCE side, this is something that the Fed uses to try to dictate kind of where policy should go. In April, it was up 6.3% year on year versus the estimate of 6.2. So again, you see that little bit of a pause. We've had these pauses before. We do think it accelerates in May, just given some of the underlying. Core PC, 4.9%, right in line with estimates. And then the headline came in at 0.2. So again, the pace slowed, but that's where we do see that acceleration as we go into some of the through the rest of May. This is where we're seeing some of that bounce in the goods trade balance, sharp bounce in April. Goods deficit to 105.9 billion versus the estimate of 114. Exports increased by 3.1%, and imports was negative 5%. So again, you're still seeing some of that movement, but exports. But now the problem is when you look forward, we've seen new export orders slow down. We've seen new orders slow down. So again, that's going to counter some of that exports. There was some backlog. So we do expect to see exports slow a bit, but also imports, just because we still have the China impact where they slowed down their exports due to lockdowns. And that's really gonna hit in about the middle of May, and that really accelerates through June. And I mean, given based on how quickly China comes back, could go through at least the first 2 weeks of July. So we're gonna get some of that benefit. So even if we get exports slowing, imports will also slow. So we should hang out right around this level. Then when we look at monthly change in April PC inflation, here's where you get that deceleration. But again, this is something that we're thinking is a bit more temporary, and we will see a little bit of a bump closer to about 0.4% as we go forward. Now, when we look at housing real quick, so we did the housing segment, and then some of the new data came out after we filmed. Nearly 1 in 5, or 19.1% of home sellers dropped their price during the 4-week period ending May 22nd, the highest level since October 2019. per Redfin, firm's home buyer demand index is also down 12% year on year. So again, you're starting to see some of these cracks. It's just price, rates, pressure on the consumer, and all of this is really starting to show up in some of the data. And remember, April and May are supposed to be the big kickoff for that home shopping, the home buying experience, which is typically spring and summer. So one of the other pieces that we wanted to look at is the annual change in pending home sales fell 11.5%, and it's hovering near recessionary territory. Again, just there's a big slowdown in terms of just new homes being purchased, just purchases in general, and price is a big piece of it. And I thought this was a really good chart that looks at some of the different drivers. So you have mortgage rates in blue, which are obviously surging. They're at 5.25%. Buying conditions for homes in orange, according to University of Michigan, is the lowest ever. And this is going back through the 70s. This is in people's view the worst time to buy a home. So they think it's the worst time to buy a home. Rates are going up. Real wages are falling. Again, all of these pressure points. Then you have tanking. What is the reaction to that? Well, when you look at that green line, you have a falling existing, and then when you look at new, which is the purple, home sales also struggling. Again, this is a trend that we do think continues at this point. So that's what we have for you today, keeping it a little bit shorter. I know 15 minutes probably isn't all that short, but again, we had a busy week. We had a lot of stuff to cover. And then next week, we are back to our normal schedule. Just flipped. Econ will come out on Wednesday, EIA on Thursday, just because we have Memorial Day. So we hope you all enjoy a long weekend with family and friends, enjoying some barbecue. And again, thanks for watching. I'm Mark Crisano, founder and CEO of C6 Capital Holdings, coming to you from Prime Vision Network. Have a happy Memorial Day.